Yo, what's up everyone? It's your boy Looney back with another market breakdown. And today we're diving into a hot topic, and that is dividend stocks versus covered calls. Which one pays better right now in 2025? Before we start, quick shout out to the Discord. It is free to join. And then I also have a premium version with more perks. You get one-on-one coaching, trade alerts, and giveaways. You can check it out. All links will be in the description. And today I'm going to break down the pros, the cons, and I'm going to show you how both play out with real examples from my own portfolio. So if you're trying to build income from your stocks, this is the video for you. First up, we're going to look at dividend stocks. So if you guys don't know, dividends are payments that you get from just holding shares. So I'm going to go over some reliable income plays. So think of names like SCHD, VYM, and even Schwab. They pay you for just holding shares. So let me pull up SCHD because I own a few shares of that. And it's the Schwab US Dividend Equity ETF. And right now, they pay about, I believe it's 3.5% yield per year. Let me see what it says here. 30-day, it says 3.97. So right around that 3.5% that it's paying annually. And you get to receive dividends. You can see here, I got $4.26 and I reinvest it. So I'm putting it right back into the shares. Now, I only own 17 shares, so it's not a big payment. But if I were to own 100 shares, I'd get a lot more payments for the quarter. It'd probably be 4 times as much, maybe like $15 or $12. So it's pretty interesting. You could reinvest it. You could use that cash for anything else. And it's pretty similar to covered calls because you're getting that income just for owning the shares. And if the stock appreciates, obviously your payments will be more because the dividend is a percentage. So if your value goes up, then also your dividend goes up because it's based on a percentage. Now, like I said, here are the pros. The pros are that it is true passive income. You don't have to do anything. You could just sit on the shares, let it go for years, for months, for however long you want to hold it. And generally, these are great for long-term growth because SCHD is a pretty stable position. It doesn't go up, it doesn't go down too much. So you don't really have to time it too much. Obviously, if the market's down, it does go down, but it's very slight, and vice versa. If the market is pumping, this stock or this ETF also goes up. Not as much, but it does. And that's why it works well in a retirement account, because you don't have to do much thinking and there's not much research needed. You could just sit your money here and it will earn consistent returns. Now, the cons are that there's fixed yield. So it doesn't really grow unless the dividend grows. So if the stock doesn't grow, if the dividends don't grow, you're not earning any more. But if you reinvest, you can make more by just putting more cash into it. Other thing is it does take a lot of capital to generate meaningful cash flow. And that's why I don't have a huge position of this stock, or I'm not rushing to get into this position, because when the market crashes, this stock is pretty good at holding value. So I decided to invest in other stocks that were a lot more beneficial for me. And that's called opportunity costs. I didn't want to miss out on those. And instead, I invested in SoFi and other stocks, Hood. And we'll get into that because I actually own those shares and I'm doing covered calls. So the last one is it doesn't hedge short-term downside. That's the last con of this. And you'll see covered calls do actually hedge somewhat on short-term. Okay, so let's pivot to covered calls. And this is where I usually invest. I made more weekly income in 2025. And you have to own 100 shares of a stock to sell a covered call on it to collect a premium. It's very similar to a dividend. These premiums you get paid for owning the shares and selling an option. So let me pull up a SoFi call because I have 4 covered calls going on SoFi, and I sold them for a total of 196. That 196 is your premium, and it goes into your buying power, and you can't automatically set it up to reinvest, but you can reinvest that 196 into that stock or other stocks, and it's very similar. You get paid on a weekly basis, a monthly basis, depending on your expiration. So I made 196 right away, and I could use whatever I want with that. And if you do this every month or every week, you can make significant gains. And let's get into the pros of doing covered calls because it's what I've been discussing, but let's get more into detail. You do get higher yield potential. So it's often like holding a double dividend stock because you can actually sell covered calls on stocks that hold dividends. And also just overall, the return is higher for potential because the stock goes up and the premiums increase. And even if the stock goes down, you can make money on the premiums. So the second one is weekly and monthly income, whereas dividends are a little bit more quarterly. Sometimes they do monthly, but overall, mostly quarterly. But with premiums, you could kind of control it. So you can control the strike and the time. I like to do weekly, monthly. You can do multiple months, but the sweet spot is that 4 to 6 weeks, 1 to 6 weeks really, and you can generate consistent income. Now, the cons of it is it's not really passive income. It requires attention. You have to be looking at this stock when it expires, whether it's going to go into the money, and you might have to roll. There's a lot more maintenance with this, so it's not necessarily passive. The next con is you can miss upside if the stock runs up. So SoFi, if it runs up past $13, unfortunately, I miss out on those gains. I do get to collect that 196 premium, and my break even is 13.49. So really, if the stock goes past 13.5, I start to miss out on those potential gains. And that's not the worst thing in the world. You can roll it, and rolling, you don't earn as much premium when you do roll, but you can work around things and play with when your stock is in the red or your position is in the red. And the last con is it requires 100 shares per contract. So you need to own 100 shares of SoFi, whereas dividend stocks, you could just own 1 share. You could own 2 shares. You don't need that 100 shares to receive the dividend. And with covered calls, you do need to own the shares. There are some workarounds. You can do a credit spread. You can do a poor man's covered call. I'm not going to go over that in this video, but that is an alternative to owning the shares and collecting premium. Now, just last month with selling options, and I do cash secured puts as well, I am up 3%. So actually really good, and it helps hedge a little bit of the downside or protects myself from some kind of downside. Whereas the dividend I swapped over to is about $4. So although I don't have many shares, I did make a lot more return with these option plays. And if we look year to date, up 15%, so even better. So just to wrap things up, which one is actually better? So it kind of depends. If you want to grow your portfolio, covered calls are great if you manage them right. That's what I like to do. I personally like covered calls a little bit better, but if you want something more hands off and less stress, dividends still hold value. I do use both. I have dividend stocks for safe long-term plays, and then I have covered calls on my 100 share positions for weekly or monthly cash flow. Drop a comment below. Are you more dividend or are you more covered called? And don't forget, if you want to see my real-time trades or get coached on how to run these plays yourself, hit that link in the description for the Discord. Like, subscribe, and I'll see you in the next one. Peace.